Welcome to This Explainer. Okay, imagine for a second that you've just found it. The absolute perfect house. You know, it's got the big kitchen you've always wanted, the sprawling backyard for the dog, and it's literally right in the middle of a great neighborhood. You are completely in love. But then, you take a look at the price tag. Ouch. For most of us, that number is massive. It's way, way higher than what we have sitting in our checking accounts right now. So let's dive into this massive price tag. Because today, we're going to look at exactly how everyday people manage to afford it and how you can too.
So, the crucial question we have to ask is, well, how does everyone else do it? Because the reality is, very few people have enough savings to just buy a home outright. It's incredibly rare to walk into a bank, drop a duffel bag of hundreds of thousands of dollars on the desk, and buy a house with pure cash. Instead, pretty much everyone uses a very specific financial tool to bridge that massive gap.
And that tool is a mortgage. Actually, the history of the word itself is super fascinating. Mortgage comes from an old French term meaning death pledge. I know that sounds intensely dramatic, right? A death pledge? But don't worry, you aren't signing your life away. It simply means that the pledge dies, or, completely ends, once the loan is fully paid off. It's just a finite agreement.
Here is our agenda for today. First, what is a mortgage? Second, the lender's safety net. Third, principal versus interest. And finally, the 30-year breakdown.
All right, let's jump into Section 1. What is a mortgage?
At its absolute simplest level, a mortgage is a legal agreement between you and a lender to purchase a property. The lender, which is usually a bank or a credit union, agrees to do the heavy lifting for you. They provide the huge amount of upfront funds you need to actually buy the home today. And in return, you make a solid promise to pay that exact amount of money back over a set period of time, plus an extra fee called interest.
And this brilliantly illustrates exactly why we use them. Beyond the obvious fact that most of us don't have piles of cash lying around, a mortgage is a powerful tool that allows you to own a home much sooner. You get to move in right now. Instead of waiting decades to save up the full purchase price while, continuing to pay rent to someone else, you can move in and pay for your own home in manageable monthly installments. And importantly, this lets you start building equity, which is really just the portion of the home you actually own outright as you pay down that debt over time.
Moving right along to Section 2, the lender's safety net.
Now, you might be wondering, why on earth would a bank just hand over hundreds of thousands of dollars to you? The answer comes down to how lenders protect themselves. You see, there's a huge difference between a mortgage and, say, a credit card. A mortgage is what we call a secured loan, and that brings us to the concept of collateral. When you sign a mortgage agreement, you're legally telling the lender that the home itself acts as a guarantee for the loan. The lender effectively holds the property as collateral until you make that very last payment. It's basically their ultimate safety net.
Because they're lending you such a massive amount of money, they need to know for absolute certain they can get it back. This introduces a scary, but totally necessary term, foreclosure. If you stop making your payments, what the banking world calls defaulting, the lender has the legal right to take possession of the home through the foreclosure process. They can then sell the house to recover the money they lent you. This really clarifies why collateral is so vitally important to the lender.
I know that sounds a bit intimidating, but there is a major silver lining here. This collateral structure is the exact reason lenders feel safe enough to offer you this loan in the first place. Because the bank feels incredibly secure knowing they have the physical house as a guarantee, they can offer you much lower interest rates compared to an unsecured personal loan or a credit card. So your willingness to use the house as collateral actually unlocks much cheaper borrowing costs for you.
All right, on to Section 3, Principal versus Interest. Let's dive into the core conflict of your monthly payment. When you write that check to the bank every month, your money doesn't just go into one big pot. It's usually split into two completely separate buckets. First, you have the principal. This is the actual amount of money you originally borrowed to buy the house. Every time you pay toward the principal, your total loan balance goes down. The second bucket is interest. This is simply the fee the lender charges you for the privilege of using their money. It's essentially the cost of the loan itself.
So, here's how these two buckets interact. At the very beginning of your mortgage journey, the vast majority of your monthly payment goes straight into that interest bucket. But as the years roll by and your principal balance gets smaller and smaller, the bank charges you less interest. That means more and more of your monthly payment starts flowing into the principal bucket, which actually pays off the house. This fascinating process of gradually paying off the loan over time, where the balance shifts from mostly interest to mostly principal, is called amortization.
And that brings us to Section 4, the 30-year breakdown.
What's really interesting about this is actually seeing it in action. Let's ground this with a real-life example using realistic numbers. Imagine you're buying a house.
You put down your deposit, and the amount you actually need to borrow, your principal, is exactly $200,000. You secure an interest rate of 6.5%, and you agree to pay this back over a standard 30-year term. Doing the math on that, your required monthly payment for the loan itself is going to be exactly $1,264.14 every single month.
Now, the brutal reality of month 1 is pretty clear. You send the bank your hard-earned $1,264. But because your principal balance is at its absolute highest right now, the interest fee is also at its highest. A massive $1,083 goes straight to the bank as pure interest. Only a tiny fraction, like $180, actually goes toward paying down your principal. Honestly, it can feel like really slow progress at first.
But let's fast forward and see how this builds over time. Thanks to the magic of amortization we talked about earlier, by the time you reach year 15 of your 30-year loan, things look very different. Your payment has leveled out to an almost perfectly even 50-50 split between interest and principal. You are steadily, solidly knocking down that original $200,000 debt.
And this brilliantly illustrates the total victory of the final year. Look at year 30. For those final few payments, almost your entire monthly check goes directly to your principal. A staggering $1,257 pays off your house while you're only paying about $6 or $7 in interest. The death pledge is finally coming to an end.
Now, before we wrap up, I want to leave you with a highly empowering scenario. Understanding exactly how principal and interest work gives you an incredible advantage. Think about it. What if you ever have a little extra cash in your budget? What if you decided to intentionally pay an extra $200 directly toward your principal every single month, completely bypassing that interest bucket?
Well, by adding just that extra $200 a month to your principal, you'd completely pay off this 30-year loan in just 21 years. And even better, because you eliminated that principal so much faster, the bank literally couldn't charge you interest on it for those extra 9 years. You would save a massive $90,000 in interest costs just by understanding how your mortgage works. It's a real game changer.
So, let's wrap up this explainer with a quick recap of the key takeaways we've conquered today. A mortgage is simply a legal agreement to borrow money to buy a home. We use it as a financial bridge to let us move in now and build equity rather than waiting decades to save up cash. Remember, collateral, the home itself, is the security for the lender, which is exactly what keeps your interest rates low. And finally, always keep in mind the difference between principal, the actual amount you borrowed, and interest, the fee you pay for the privilege of borrowing it.
Buying your first home is a huge, and honestly, sometimes intimidating milestone. But by understanding these foundational concepts, you are already way ahead of the curve. You've taken a huge step toward real financial confidence today. So I'd love to know, what other home buying mysteries or real estate topics do you want us to decode next? Leave your thoughts, keep learning, and hey, happy house hunting!